celebrity allure of entrepreneurship, many exceptional entrepreneurs remain shadowed. Here, I team up with these hidden talents to unveil their challenges and successes. Dive in with me to unearth entrepreneurial gems, learn from our experiences, and get educated. Neil Cuggy, thank you so much for being on the show. It is so good to see you, brother. I am super grateful that you're here. I know you're a super busy guy. And I guess for the guests, I'll just maybe do a little intro here on your background, but you're currently, you're the co-founder, current president and COO of Goodfood Market Corp, which is, trades as Goodfood. You're Canada's leading, I think, e-commerce food subscription company at the current time. And I know you graduated from McGill University through a commerce program, I believe, and then you got into investment banking as an analyst. And then in 2015, started Goodfood with yourself and Jonathan Ferrari, who's a friend of yours, and I think you guys worked together. And then from 2015 to I think 21, you guys grow this thing to top line sales of 380 million with 5,000 employees. I mean, it's an unbelievable feat. Super impressive. You're Ernst & Young Entrepreneur of the Year in 2018. And all doing this while getting married, having a couple of sons, and just that little stuff. But I mean, I have the pleasure of knowing you personally, and beyond all that stuff, I will say, for the listeners, you are the one guy that your compass points to true north, and whenever I am have to really think about, not necessarily what the right thing is to do, but the honest and most integrity, you're kind of a guy that pops into my head about who I would emulate. And so I really, really, really appreciate you taking the time. I know you're super busy for being on the podcast, and I'm excited to just have a conversation with you.
Yeah. Thanks for the kind words, and thanks for having me. I'm really excited to talk shop with you today.
I'm keenly interested in what's happening in Goodfood and in the market right now. I think, everybody's talking about the markets and where the economy looks to be going. And, we're in a post-COVID rollout, and I'd be just kind of curious, in the present moment, I'm sure we're going to get into the past, I'm sure, because I'm also interested in that. But in the present moment, how are you guys doing? What do you see on the forefront? What's your highs? What's your opportunities? All that stuff.
Like a lot of e-commerce companies benefited tremendously from the lockdowns and the kind of stay-at-home narratives that were going on around COVID. So, like you said, we exploded to almost 5,000 employees and almost 600 million of run rate sales at one point, and started to invest in a bunch of other business lines to continue to have a pretty aggressive growth path for the next decade. A lot of those businesses needed more capital, and when capital started to kind of dry up, we had to make some tough decisions and cut some divisions, cut a lot of people, and kind of right size the operations. The benefit of that timing was we were making tough decisions probably 12 or 18 months before a lot of other Canadian entrepreneurs and businesses were making tough decisions. So, I remember a couple meetings with you, Dwayne, that we were talking about what a recession actually looks like. You guys haven't seen a real recession yet. It's going to get bad. It's going to get ugly. And taking those comments very seriously and acting on them immediately has put us in a really strong position today. So the company's going well. Having a lean and mean team focused on free cash flow now as our North Star versus revenue generation or subscriber growth or any kind of vanity metrics that we would have been going after in the past is alive and well. And we just reported our results for our fiscal year last week, and it was our first year of full profitability, pretty close to free cash flow break even. So the turnaround for our business is kind of complete, and now we're looking to how do we grow this thing to multiples in its current size, but on a free cash flow basis rather than just a revenue or a subscriber basis. So it's a really good cultural shift that's happened in the business, and it wouldn't have been possible if we didn't, make tough decisions and kind of stare in the mirror and say, like, what the hell are you guys doing? We gotta change how we're operating. So yeah, it's things are good. Things are rolling. Customers are super happy.
Congratulations to you guys. I mean, there's a lot in there. The first thing is that struck me is you don't hear a lot of companies talking about free cash flow, especially, going through this, the past several years that free money or low cost, very low cost money has been the driver of revenue growth. That's what everybody talks about. And to hear somebody actually sit here in a seat, and say, hey, we're focused on free cash flow is, because look, we're in two different kind of arenas. You play in a huge, $300 million revenue kind of business. But, as an entrepreneur, that's all I think about is free cash flow. So congratulations. 'Cause I don't even know where to start on everything that you kind of unloaded, because, just to get to that place, is amazing effort, and feat by you and your leadership team and I'm sure all, the consultants that you have that are kind of helping through this process, which probably often get in the way. But that's a personal opinion. Maybe if we could roll back to maybe the beginning and then work through this a little bit, if you don't mind, which would be, kind of COVID hits, subscriptions rise, I guess. I think that's how you guys talk about your businesses, through subscriptions. Or am I wrong on that?
Nope. Yep. That's it. It's subscribers, which represents basically a Canadian household.
Right. So subscribers start to rise, COVID, whatever. And then, some decisions start to get made, I think is what you were talking about, is expanding the lines. Here's the opportunity. We're growing, how can we take advantage of this? And what kind of strategy were you guys looking at? Like, what lines did you hop into? And then maybe we could just kind of glean some experiences from you that maybe, cause everything's a cycle. Business is a cycle, and I think we're moving. My personal opinion is we're moving into a downward cycle. But God, who knows? Like, governments start to print money and do whatever and save the world. It's we could just be right back off on another cycle. But I'm curious, when you guys made that decision, what were you looking at? What were some of the quantifying details around where you would grow and how you wanted to expand?
Yeah, it's a great question. I think, like, for one of my core beliefs is really you're the average of the people you surround yourself with. And I think in 2018, 19, and 20, we had a board and advisors, whether they were paid consultants or advisors or mentors that were around us, John and I being us, my co-founder, that were very growth oriented. And during that season, or during that part of the cycle, you were rewarded as an entrepreneur for growth. And it didn't have to be growth in free cash flow. It could be growth in revenue, growth in subscribers, growth in downloads, growth in users. Pick your metric for whatever business it was. But so many of these kind of unicorn private companies were created because of easy money and metrics that were ultimately moving in the right direction, but weren't generating sustainable business economics that people that didn't have access to the cheap money or didn't want to use cheap money weren't using. So for us, we were very conscious of what game we were playing. We were in a growth business. We're in a direct to consumer food business that requires a certain amount of scale to be profitable. And we knew that you couldn't be a profitable subscription food business at 20 million of sales. You need to have some scale. So playing playing the growth game while it was available was the right move. And our advisors and board members around us were reinforcing that fact, and investors as well. Like during COVID, it's crazy. Like we would get calls from investors and be like, "Hey, does your wife want some jewelry or like a new cottage? Like I got 30 million for you if you want." I'm like, "What? Like this can't be a healthy business environment if we're like weekly we would get phone calls like that."
Are you
for
serious?
people trying to buy stock. Yeah, for sure. It was eerie, and now that I look back on it, so
Sorry, are these people trying to buy stock from you, or they're trying to invest in your business?
well, they're trying to buy stock directly from. They're trying to buy large chunks of stock from whoever could sell large chunks of stock, and John and I happen to be large holders of stock, and they know that with the appreciation in the stock price, there's ability to take some of the chips off the table and invest it in other things. And whether it's investing it in a cottage or jewelry or other businesses, they didn't really care, but they were trying to play to our emotions and kind of using different tactics to buy into Goodfood at the time, and to buy into ultimately what was a rising tide for a lot of public companies. So so that was the kind of
bubble. If that's not a bubble, I don't know what is. That's insane.
That was kind of the context, right? So that's exactly. So that's the context that was happening, and I would say we knew we were in it, but you don't know when the music's going to stop either, right? So you kind of want to continue to play the game, and because we had so much access to capital, and the business was growing, like we were growing revenue quite substantially, we were growing gross profit quite substantially. Ultimately not focused on bottom line profitability, but had a pretty clear path to change back to profitability if we wanted to. And we had certain kind of sales criteria and thresholds that we would be comfortable getting profitable at. And then the world kind of changed pretty quickly. So we started to invest in the what's known as kind of instant delivery. So delivery to the home in under 30 minutes. It required slightly different operations, slightly different website, slightly different core competencies ultimately than what we have in our base business today. So there was a large investment to go into this 30-minute delivery available in Montreal, Ottawa, and Toronto that we had to make. So we kind of pushed hard into that, and investors were excited to do that. The board was excited to do that. John and I were excited to do it because that market was ultimately going after the Canadian grocery market, which is one of the most profitable grocery markets in the world because it's an oligopoly.
And when you're talking about the delivery part, you're not talking about your meal kit business. You're talking about grocery business. You're at home grocery delivery, which I think is like such a smart. I mean, I could see why you guys would want to get into that market. And are you still in the market or in?
So no, so we pulled the plug on that just over a year ago now, in October of 2022, and it was a function of the time. So we needed more capital to get that business to scale. But at the time, we had this meal kit business, this direct to home subscription business that was generating $400 or $500 million of sales, generating a good amount of profit, and that profit was being reinvested, plus additional capital being reinvested in building out the infrastructure. So we needed a hub and spoke business model with lots of hubs and lots of spokes to be able to deliver about 1,500 ingredients to customers' homes really, really quickly. And the other thing that was really interesting about that was the net promoter score of that business. So the simple question to consumers of how likely are you to recommend this service to your friends or family was extremely high. It was like 9 on 10 or 90 plus NPS, which is Apple has like a 60. So we're saying, wow, customers really love this. Are they willing to pay for it? Are they willing to pay enough to make it profitable? Those are all questions that we needed to figure out, but we thought we had a good, a different sauce than the other companies around the world that were pursuing that business model. But ultimately, we needed about $50 million of extra capital to kind of scale it up to the size we needed. The capital markets kind of closed up, and we had to make the decision to say, okay, we got to cut that and scale it down. pretty much aggressively. So we can go into that part of the journey, but it was a lot of tools in the tool belt were learned during that period as well.
If there was a hindsight moment that, when you look back on it and go the metrics made it sound great. I personally think it's, a great business to be in. I think it's a needed business to be in and needs to have somebody who can execute it well. I mean, you guys have a great reputation in the meal kit. Like, your meals are amazing. Not to make this a commercial about good food, but they really are. Like, you have some phenomenal menu recipes in there and food selections, and it's fantastic. But the hindsight, like, of where you go, man, like, maybe it was missed assumptions, which are typically the things that really not kill the entrepreneur, but they certainly can cause a lot of aches and pains. Was there one or two like real hindsight moments where you went, if we had really looked at this closer, we'd have seen something happening?
Yeah, I think I think of the Keith Cunningham, like unexamined risks, missed assumptions, and excessive optimism or unchecked optimism, right? Like, I think of those three kind of things and how they play into the decision. So for sure, a couple key moments come to mind. We had some we were a very growth oriented executive team, led by John and myself. And because of that, we always said, like, we're going to conquer the world, right? So what's the next step? Keep going, keep growing. And all the reinforcement was showing that was happening. And I think we could have been doing it in a much more controlled way. But there was a moment where a couple board members and a couple investors, we were having a couple kind of strategy meetings and discussions, and they basically put together a presentation to John and I and said, you gotta get out of the meal kit business. Like, you gotta stop.
Out of the meal kit business.
You gotta stop selling meal kits. And at the time, it was an interesting thought, because we were betting a lot of the company's future on the next leg of growth, which was the on-demand delivery, which customers were loving. We had a path to profitability. We were doing really well. It was scaling really quickly, and the employees were extremely excited about it. But that meeting was like, whoa, okay, well, I don't think we should get out of the meal kit business. Like, that's the bread and butter. That's the golden goose right now, and it's allowing us to do all these things. So, that was one conversation that I remember having, and it's a little bit of a gut check moment to say, okay, well, are you surrounding yourself with the right people? Are they giving you the right advice at the right time? And is it in your best interest? Is it in their best interest? Like, most investors have a portfolio of companies and they want every company to succeed. But if one doesn't succeed, it's not necessarily the end of the world. So I remember that moment specifically was pretty powerful. And then the other moment that is definitely very pivotal is we started to hire experts and invest in like longer term projects, which we had never done before. We're scrappy entrepreneurs. We'll get our hands dirty on whatever needs to be done. We built the business portioning food every night and weekend, doing deliveries, answering customer service email. Like, we're in every detail of the company, and we really changed that mentality and started to say, oh, this person from this big company knows better than us, because they've been here before. They know what world class looks like, whatever story it ends up being. So I think those two, one was more of a meeting and a kind of a series of conversations, and one was a cultural kind of shift that, when I look back, I was like, those two things probably put us in a position where we could have made the money we had go a lot further, which would have put us in a potentially better position. And we got to make sure we're running our company with our own interest in mind and the shareholders' interest in mind, because it's not always the case when people are in a bubble type environment. So and we're still friends with all these investors and people that I'm talking about. Like our board is fantastic and provides a lot of good advice. So there's definitely no hard feelings. And it was like you said, it was part of the cycle. It was a sign of the times. But know where you are in the cycle for sure.
Right. Yeah. I mean, that's a huge lesson for everybody, whether they're running a $250 or $300 million business or they're running a $1 million or $2 million business. Is you got to know where you are in the cycle. And I'm curious, like earlier, you just a minute ago, you'd mentioned that, you know, your executive team was pretty growth oriented. And then, you know, with this experience that you've had, has it changed your outlook of who you fill in the seats in terms of, you know, the executive team or the board or the advisory board, so that you have a disbursement of different types of thinking, although that might be a little bit contrarian inside those meetings and might be a little bit more push and pull and less necessarily agreement. But have you guys looked at that as an overall strategy? I'm curious.
Yeah, for sure. I think like it's pretty fundamental, I would say. Like on the exec team and the I'd say the whole team throughout the whole company, we went from you know, you're going to hire somebody from the outside and they're going to bring fresh perspective, new blood, potentially more experience, to humble and hungry and internal focus, which is ultimately what got us to continue to grow at a very rapid pace for so many years. So kind of going back to the basics and, you know, promoting within, surrounding people with external coaches and advisors to help them kind of develop, but really there's not a legacy meal kit business or a legacy food subscription business that you can go and say, oh, somebody's built this before. Like there's very few places to go and say copycat from there. So definitely much more internal promotion focused, getting the people who have, you know, the company tattooed on their arm type of vibe to help steer the ship. And then I think for us, like the most important thing is what is the North Star, right? And so the North Star of revenue, we as an executive team were really good at finding revenue and ultimately trying to generate as much profitable revenue as we could, but the bottom line wasn't the focus. Like we weren't really talking about it because the market, investors, stakeholders were not rewarding us or any company for that matter for anything other than revenue growth. To now the advisory board and the board of directors, like we're very conscious to know that the environment has changed. We're a different part of the cycle. Money costs money now. It's not free anymore, and it's much more scarce than it was. So use it wisely, protect it, and some companies can still use it as a weapon, but we're not in that position anymore. So you know, surrounding people that have grown companies by focusing on free cash flow or focusing on acquisitions or running overseas teams versus all downtown Toronto or San Francisco expensive talent that necessarily doesn't produce as much as someone that is hungry and humble from another part of the world. So those types of tactics have been super valuable in the last little while, and those are the conversations that I find myself having with a lot of entrepreneurs as well.
You know, it's funny. One of the things you were saying is like covet cash is you know, a huge lesson. But I mean, and again, I'm going to go back to, because there's probably a lot of people who would have difficulty, you know, relating to, you know, a business of your size. But I think the principles that you guys are using could be used in any size business, and you know, business owners have to be very, very careful, you know, to know who is giving them advice. Well, first of all, get advice, go find people who, you know, you can, whether you have to take them out for dinner or whatever you've got to do, to get the advice and time to just ask some simple questions, but, and then take those things with a grain of salt. make sure they're trusted and they've got experience. One thing I see so often is that people don't have experience in the cycles because we've been through a pretty, upward trend since, 2010, let's call it. So we're 13 years. I mean, you get people in their mid 30s, they don't know what it was like before.
Yeah.
Old guys like me, we've seen it, a couple times and have been stung by it. So you had just said, like, you were talking with entrepreneurs. What's the big thing that you're seeing now, and what's the biggest concern with people, your peers, people that you're working with on a consistent basis, whether it's on the legal side, whether it's on the advisory side, the board side?
Yeah, I think the biggest conversation that I'm seeing these days, and like the entrepreneurs that I talk to are really a mix of background, mix of businesses. I'm not super plugged into the venture capital community or the tech community. Like I have friends in a lot of different types of communities and entrepreneurs that start all kinds of different businesses. So I think it's been pretty interesting to have kind of the conversations across all of that spectrum, because everybody's talking about the same types of things. Like, do I raise money or do I bootstrap my business? And there's lots of people that would have been not even asking themselves that question anymore. It's like, do I get profitable, or what level of sales do I need to get profitable, or how profitable do I want to be? Like, those are questions that, 10 years of running Goodfood, never
Heard
the
that.
other, like, it was always like, how can I get a quick win? How can I sell the business? It's just totally different, it's pretty amazing. There are still some companies that are focused on revenue only, or user metrics that grow the business, but they're the ones that are like shooting for huge, massive companies and have relationships and cash to go after that approach. So I think it's kind of refreshing, honestly. Like, everyone thought there was one way to build a business, right? And I mean, the whole premise of your podcast is that there's a shitload of ways to build a business. So don't paint us all with the same brush, and use the tools at the time with what's being presented in front of you. So I'm talking, like, I'm advising another direct to consumer business right now that it took them 3 or 4 months to figure out their product market fit and what they wanted to sell and how they were going to sell it. And now they're growing like 50% a month. And it's like, it's crazy. And they're profitable at like 6 months in. They're profitable now. And they're like, should we raise some money? And I was like, I mean, do you want to raise the money? Do you want to report to other people and check in on stuff? Or do you want to just keep doing what you're doing? Like, you have the choice, which is an interesting position to be in.
They're profitable after 6 months. So,
they're on fire. Like, it's like 6 months since finding product market fit. So they're generating, they're over a couple million of revenue right now, and in a high profit margin business, and just a couple guys that are working their ass off. And they wouldn't have even thought twice about it in the past. They would have just been like, I'm going to go raise $5 million or $10 million, and I'm going to spend my time on the plane or on Zoom calls talking to investors and pitching them and begging and pleading and everything, which is still a path, but it doesn't have to be.
So I was going to actually ask you about your past and how you guys got started, because you had just mentioned it a few minutes ago. But before we go to that, I really am interested in what your take is on accepting money from outside investors. There are a lot of people out there that have like good little businesses. I mean, we have a business right now. I just had a call last night, and our EBITDA is like up in the close to 60% range. It's super high. I mean, it's an amazing. I said to the people on the call, I'm like, this is I've looked all my life for a business like this. This is amazing. And so I'm curious for you, with your lessons and, going public, and we'll get back to the backstory, after this. But before we do, I'm really curious, what are your thoughts on, taking money? What's the upside? What's the downside? If you had to do it over again, what would be the parameters that you might take money on, or things that you would consider before you took money? Who would you talk to? What would be the process of thinking that you would go through?
Yeah, I'm happy you asking the question because it's something that is I think like there's a little bit of taboo around it for some reason. It's like, you don't talk about money, but you talk about valuation, or you talk like it's got this weird dichotomy where there's a little bit of information, but not really the right information being shared, and what it means for the founders and the entrepreneurs. Like, I'm sure everyone's heard stories about people getting founders of businesses getting kicked out of their own business, right? Once they've taken money. So that happens because they're not, they're not asking the right questions, or they're not understanding what they're getting into, or surrounding themselves with the right people at the end of the day. So some of the stuff that we look for, or we talk to other entrepreneurs about, would be, valuation is important. Obviously, like you want to own as much of the business as you feel comfortable owning. That motivates you, right? So if you want to own 100% of the business and that's what motivates you, that feels right to you, go for that. If owning 10% of the business feels right to you, then that's fine too. It's just know where you stand on that scale. And valuation is one piece. So don't maximize valuation at the cost of all the other terms and conditions of that financing, right? So we've had a lot of opportunities to take higher valuation money from people who would add less value to the business and ultimately get in the way a lot more as well. So, quote unquote, smart money versus dumb money, I think, is something to be very considerate of. So investors, money is ultimately a commodity, and investors can add a lot of value if selected intelligently and well. And then terms like some of the stuff that you see in the private markets, whether it's venture or seed investing, or even some private equity deals, like the structure of the deal, I don't think a lot of owners realize that once they've raised money from a venture investor or a private equity investor, they don't really own any of the business anymore, and your ownership becomes an option on the upside of the business. And I'm happy to kind of get into more details on that. But if there's liquidation preferences, or preferred shares or convertible bonds, like all of that in your capital structure dictates if you actually own the business after you've raised the money or not. So it might be great, like maybe you got a $10 million valuation, or 100 million, or $1 billion, whatever the number is. It's great on the press release, but in the end, you may have not made the right deal because you didn't bring the right person on, or you actually took something that you owned and controlled and gave it up without really knowing that you were giving it up. So
yeah, I mean, basically you could dilute yourself to zero almost, or practically close to zero, sometimes without even knowing it, because if you're taking smart money, there's a reason why it's smart money. Those guys are smart.
Exactly.
What's the saying? Have a guy that meets a guy with the money, who's looking for an experience, and the person with the I forget the saying. Sorry, whatever. We'll delete this from the podcast. No, we won't. But anyways, the whole premise is if you don't have the experience and you meet a guy with money, he's going to end up with what you own, and you're going to end up with nothing.
Exactly.
And so you got to be super careful with that.
So I think like it goes back to what's the path that you want to take. I think entrepreneurs today are starting to realize more than ever, especially with, I'm not super close to the whole kind of creator economy and in generating these crazy sums of money through social media. But a lot of these people, like, they own their business. They are businesses in themselves, and they own their business, and they're not going out and raising money. You can generate a very healthy EBITDA margin or business for yourself in so many different ways today, rather than just going and kind of going around town with the hat out. So don't think about it as the default. The resourcefulness needs to be there.
How much do you think plays into this? When you accept money, now you have just changed your job from being, the business owner / operator, or, at some level you're still operating the business or you're still in the business. And now you've become this, person who's accepted money, and now you are pleasing the people, that gave you the money, and you're reporting to them, and you really have to become a different, almost your identity has to change in terms of who you are and how you do business, because you just went from, doing one thing to really doing a complete different thing.
Yeah, for sure. And I think some people thrive in that structure, and others can see it as complete bog down and loss of control, right? So whatever meaning they attach to it will make a big difference on how the business can perform, because there's a lot of smart people out there that can add a lot of value, open doors, distribution channels, joint venture deals, whatever it may be. If you're going into another country, there's tons of people that can add a lot of value and give you money. But if you're focused on valuation or dilution only, you're probably giving up other things that over the life of the company could have generated a lot more value. And that was one of the reasons that we ended up going public as well. Like, we had great private investors. We didn't have access to a ton of money in the private markets. We wanted to continue to grow. But as entrepreneurs in the business, we realized that through these private financings, if we were to sell the business, we wouldn't really get much money out of it. So we pretty much just gave ourselves a job. Like, we're just taking a paycheck out of the business until the business grew to a certain size. And by going public, everybody owns common shares. It's all one class of economic rights, one class of voting rights. Everyone's equal, and we've actually gotten back the ownership of the company and voting power in the business.
So this, a lot of people, I don't know if they know this, they probably don't, but your story is it's pretty unbelievable. I'll let you tell it, but you and Jonathan are working, I think it was for RBC at the time, as analyst for the investment bank, right? For the investment
we're a couple finance geeks.
Yeah. And then, so maybe just give us the Coles Notes version on how you guys rolled this out, because it really is amazing. You ended up starting this business in your apartment.
Yeah. I'll try to keep it as valuable to the listeners as possible. So, as you're saying, John and I started Goodfood in 2015. Before that, we actually went to school together in University at McGill. I was studying finance and accounting. Really loved, the stock market, and grew up reading the Wall Street Journal. My grandfather kind of always was reading the Wall Street Journal, and he taught me about public markets and business at a high level. And I met John during graduation. Literally, he was going up and getting his diploma, and I knew we were starting a job together in a couple of months. And I was like, "Oh, John Ferrari, I know that name. I'm going to sit next to him in a couple of months." So I walked up to him and ended up shaking his hand and saying, "Hey, nice to meet you." So that was kind of 2010, and then from then we worked in investment banking, which is mergers and acquisitions, raising money for company, whether it's equity or debt financing, and really being a strategic advisor to usually mid-sized to large businesses on how to grow, how to allocate their capital, and just do right by shareholders. And that was a fantastic experience. It was 3 years of everything you've ever read about investment banking: 100-hour weeks, canceled vacations, Christmas in the office, all of those kind of challenges. But I don't think either of us would trade it for anything. And it gave us an amazing perspective on what businesses are good businesses, what businesses are tougher businesses. And we're meeting entrepreneurs pretty much every day and saying, well, we could do this, right? Like, I could run a business like this guy. And
These guys aren't that smart.
yeah, she's not that smart, or he's not that smart, whatever it is, right? So the classic entrepreneur probably mistake, but that that mentality and the fact that John and I had this kind of chemistry. We were working beside each other. We weren't necessarily working together on a lot of stuff because we were both the junior people on the team. And ultimately what we did was we saw an opportunity to go and buy a business originally. So we left RBC. We took our savings after the 2-3 years that we were there, and went out and contacted business owners that didn't have a son or daughter to take over the business. They didn't have a management team to take over the business, and pitch them. So we over about a year and a half, we contacted 3,000 companies in North America, and we put offers on about 150 of those businesses.
You did this while you quit RBC
Post
and then
RBC.
did this. You didn't
So that
do
was
this.
our first.
Oh, okay. I didn't know that. I thought you guys were kind of just doing it on the side. Before we jump into this thing, how important do you think it was for your evolution to work at the investment bank level? I feel like for me, I wish I would have done that. There's a part of me that really wishes that, I had spent time in that area, because I just feel the experiences would be invaluable. And the Rolodex that you start to build would also be, valuable as well.
For sure. Like, it was a great training ground for learning how businesses operate, especially kind of mid-size and large businesses. And originally those were all small businesses, right? So they had to do everything else that every other entrepreneur does to get big, right? So if you take Couche-Tard, right, the Max convenience store chain, you look at their business, and they started off with a couple convenience stores, and then a couple more, and a couple more, and a couple more, and a couple more, and now they're at like 80,000 stores around the world or something like that. So you start to see these threads and patterns of success, and ultimately where you can create the most leverage for wealth creation is through finance. Like, it's just, that's the reality. If you combine entrepreneurship and finance, the sky is really the limit, because financial engineering is a thing, and there's lots of money still sloshing out there to put towards different opportunities. So if you understand how to take advantage of that, you can almost create money out of thin air. Like, it's pretty amazing. In the good times, it's easier. In the tough times, a little tougher, and you have to be operating a good business to be able to do it. But the thing that really opened my eyes at that level was these people are not talking about operating the business and hitting the metrics and the daily grind of entrepreneurship. They're talking about, okay, my stock is worth 20 times earnings, and this stock is worth 8 times earnings. It's a strategically relevant acquisition, and if I buy their $100 million at their multiple of 8 times, well, it's immediately worth more than 8 times in my world. So I've created
instant wealth, instant
wealth
value. Yeah,
exactly. So I think that being exposed to that night and day is pretty powerful. And then I think that the learning training ground of, like, you're gonna grind, you're gonna work hard, you're gonna just get exposed to stuff you would have never get exposed to. Plus, I mean, for investment banking, first year out of school, I think I made 150 grand or something like that. And the most I'd ever made before was like 5 grand. So like, you go from landscaping to like, oh wow, I can afford I can buy a car,
I can buy food in a car
or whatever. Exactly. So that's the other kind of thing that helps numb the pain that you're going through for a little while too.
But I also think just the pressure and the workload and I mean, to me, that is just invaluable of to push yourself to the limits, you realize, like, and fun. Like, too many people look at that stuff as a job rather than, the process and the experience and where it's going to take you, or where the limitless possibilities are doing that for whether it's 3, 5, 8, even 10 years. Like,
yeah, for sure. And I think about it from like my kids' perspective, right? They're young, but do I want them to go through some sort of similar training ground? Like if that's what's in store for them and that's the path that they want to take, I would definitely encourage them and say, yeah, for sure. Like you're gonna learn a ton and you're gonna go through the ringer and you're gonna make some great connections that'll last you a long time. Like we went public because my mentor at John and I, one of our mentors at RBC, was at the right place at the right time, and I sent an email to him, and the next day, boom, he showed up, and I mean, we went from kind of a small growing business, but virtually irrelevant, to Canada's largest food subscription e-commerce business. So that would not have happened with if I would have taken a different job out of university.
I see so many kids in university, and they are, if they're even on their co-op process or they're coming out of university, and they're looking for the best job, the easiest job, or even the highest paying job. And I'm like, man, I just feel like and maybe this is just me. Like, I'm kind of like smash my head against the wall and kind of like a rhino, right? I'll just run through it. But to me, it's just like, you should be looking for the hardest job. I mean, that's the job, because after you had the hardest job, every job is easier because it just creates this different perspective. And so cool for you guys for doing that. Obviously it's paid off. Sorry for the deflection there and your story. So you guys start looking for businesses. You leave RBC.
Yeah. So we start looking for businesses. We had raised a little bit of money at that time to help us fund the search of the businesses. So there's a kind of a business model known as search funds now, that's grown out of many years of either MBA students or entrepreneurs just hungry to buy businesses. They get financial backing to kind of fund the search and fund some of the diligence and travel and stuff like that. And then ultimately end up buying businesses and trying to scale them. You can kind of think about it as like entrepreneurship through acquisition. So people want to buy something that has some meat already there, rather than just coming up with their own idea and starting from scratch. So that was great. That was super formative. Like I said, we looked at a lot of businesses, a lot of different industries, and what it helped us do was really again, refine what we liked about certain businesses. So, do you want a recurring revenue business, or do you want something that you need to go out and sell every day all the time? Do you want a B2C business or a B2B business? Do you want something that there's a lot of assets involved, or do you want something that's more asset light? So we started to put together this kind of wish list, and it's just that, it's a wish list. It's never perfect, but through that process, we were able to talk to a lot of business owners, refine what we liked. Ultimately, we didn't end up buying a business despite making a lot of offers, but it led us to starting Goodfood about a year and a half later with a couple of the investors. But we gave the money back, started Goodfood, and then raised money about 12 months later from that same group of investors. And like you said, Goodfood was started in our apartment. First week we had 14 orders. It was all friends and family. We were taking credit card orders over the phone. It was a Google form with the 3 recipes for the week that you would just put in your address and information. Canada Post didn't show up the first week, so we ended up doing the deliveries in my wife's Fiat at the time. It was a complete mess, but some of the most rewarding days now that we look back on it. And ultimately, we made a couple tweaks in the early days, but we were really lucky that we were selling a perishable product. So people, if they like it, they're going to need it again tomorrow or next week. We were extremely focused on the customer experience. So, we were delivering something that people were interested in exploring. And then once they tried it, they're like, oh, wow, this is really helping my life be easier. My kids are eating the stuff with me. My husband likes what I'm eating, or my wife likes what I'm eating, whatever it may be. So that was another big piece of the focus. And then singular focus on growing the business, because we needed to hit some sort of scale, right? So, we took all of our money and our credit cards and just loaded it into trying to acquire customers and figure out how to make money on a box. At the beginning, we were selling $60 retail. It was costing us over $100 to fulfill, and we weren't paying any salaries because it was all us that were doing all the fulfillment. So it was pretty bad economics at the beginning, but
So
we
your
had good
business
confidence.
you didn't make money on anybody at the beginning, really?
No,
And so,
yeah.
and you guys did you raise money, sorry, for this, or did you?
So at the beginning we didn't. It was just out of our pocket, and it was about 9 months in that we said, okay, well, if we want to move out of our apartment and get a little bit more scale, we had already started to plan the next step, and started to get to at least gross profit positive on the orders. That we started to go and talk to investors. We raised about $1 million at about 9 months or 12 months into the start of the business, and we were doing about $1 million of revenue at that point as well.
Oh wow! So you guys grew revenue in 9 months to $1 million.
Yeah, exactly. So
$1 million total, or like what were your was that?
That was probably like last 9 months of $1 million, and it was a run. We were really focused on the run rate because of the subscription and recurring revenue aspect of our business. So
right.
We were at about $1 million of run rate for the month that we ended up raising money. And to your point about like what's good money and what's bad money, what to look out for, we were blessed. Like we got three amazing investors who are all ex-entrepreneurs. There was no BS. Like they're just straight shooters. They love business. They love the game. They loved us and helped us tremendously. So it was a huge blessing to get those three people on board at the time.
They had to have loved you. You're doing $1 million out of your apartment. I mean, mind you, you're not making money on it, but at least you're starting to you have a proof case of revenue. And so what were just before we go into the next step, I mean, this is an awesome story, dude. And great for you. And Jonathan, what was the toughest, like if you look back and kind of recall, those times being in the apartment, what were the toughest things? What were the hardest things to overcome, that if you were to give advice to a young, entrepreneur that was trying to start out, what would it be from those days?
Yeah, I think it depends on the entrepreneur. Like for me, I like to know how things work, why they work, make it better, fix the machine, like, really get the nuts and bolts of stuff to be moving well. So for me, the thing that was actually tough was staying focused on growing our number of subscribers or number of members, because I knew that, every time we sell a box, we're losing $40. Like, it's probably not a good idea to sell more boxes, guys. Like, let's go and fix that first. We're like, no, we need to, like, it'll take care of itself. We'll get some scale. We'll do it. And John was very adamant and singular in that kind of that focus, and it ended up working out obviously very, very well. So for me, the toughest thing was saying, stay focused. There's a million things broken. Your business looks like a piece of junk, but stay focused on the one thing that matters. And ultimately the other stuff will get solved by themselves, or you will have time to solve them at another point. So I think that's just so critical, because at the beginning, everything's on fire. It looks like crap. You're not proud of any of the way the sausage is made. But stick with it. Like it can get better in a lot of different ways. And if you over engineer it at the beginning, you're not going to have any customers anyway. So it doesn't really matter. Just
right.
Start.
So you guys had a single vision of growing subscribers or users or clients, and then like put aside all the stuff that you can get sucked into in the minutia of the business, and keep track on that singular focus. And don't.
We had a scoreboard. Yeah, we had a scoreboard in the apartment that was just a whiteboard, and at the end of the week or the end of the month, it was 100 subscribers, and then 200 subscribers, and then 300 subscribers, and then that was it. And it was just the only thing on the whiteboard was the ending balance of that month, and it worked.
Your apartment, like, it must have been full of shit in there.
Oh my God, yeah. Every weekend, my dad and I would go and buy a fridge off of Craigslist and plug it into the wall. We laugh because John's apartment didn't need any heating, because he just had fridges and freezers lining his apartment wall. It was, some good days. That's
funny. I mean, I think that's good advice for young entrepreneurs, is to like really know, what business are you in, and really work at that business, and don't get sidetracked. I mean, I see that all the time, especially in our own offices. People getting sidetracked from their single and solitary purpose, and they get pulled into these side things. They're just distractions.
For sure.
Yeah. Yeah. Cool advice. Sorry for interrupting.
Not at all. So yeah, so the next phase was, we could just took that money, hired a couple of our first employees, and started to continue to grow. We learned, we were, John and I were both finance background before, right? So marketing was not really something we believed in. We're like, oh, if you build a great product, people will come. But we realized that, okay, well, a good referral system and a great product can get you so far, but what you really need to start to do is to invest money in marketing and invest it intelligently. So we started to do that with that first round of financing, and thankfully, one of the other kind of criteria that we had aligned before starting Goodfood was a growing industry. Like it's really tough to make money consistently in an industry that's shrinking or kind of saturated. There's ways to do it, but it's a different strategy altogether. So for us, growing industry was important, and online grocery as kind of the macro level industry that we consider ourselves to be in, and that worked out. That worked out well, and in that industry, we were gaining market share, and continuing to grow with it. So we raised a little bit more money from the same investors, invested a little more in marketing, grew the team a little bit, and we were thinking about going out to raise a little bit more money. So we raised 2 rounds of $1 million over 2 years, and I think we were at maybe 15 or 20 million of sales at that point. And then I emailed our investor pitch deck to my previous mentor at RBC, like I was saying, and he immediately responded, "Hey, can I come to your office tomorrow? I got an idea." I'm like, okay, cool. Like we were looking for $3, $4, $5 million, continue to play this kind of game, maybe expand nationally. At that point, we were only in Quebec and Ontario, eastern part of Canada. And he showed up with one of his colleagues and said, "Hey, we think you can go public. So we got 15 million of sales. Like, what do you mean we can go public?" He said, "We think you can go public at $100 million valuation." He said, "Okay, well, I just got a term sheet from another investor at $15 million valuation. So tell me more. Like, why should I listen? And why is this not a scam?" And basically, John and I spent the next 48 hours just kind of like throwing this idea around with them and figuring out like what it could mean, and what are the risks, and what are the pros and cons. And ultimately, what it came down to was, if we can spend 2 weeks on the road and see if investors like our business, we'll know if we can go public or not. And I trust the guy's name was Derek, and I trust Derek that he's given us straight advice. He's not acting in his own self-interest in any way. He's going to get paid off this, but I think he believes it as well, and he's been a user actually of the product for a while as well. So we did an IPO roadshow with like 48 hours notice, and I think we did 200 investors in 2 weeks. I remember there was like a 4 a.m. meeting in Edmonton. It was just like basically you're in a Yukon GMC, going from building to building, boardroom to boardroom, pitching the same, like almost like a robotic repetitive nature, but met a ton of really interesting people and investors, and through that, so we ended up going public. We raised just over 21 million, I think, at the time, and then, like I said before, got all of our cap table cleaned up. We ended up owning, I think John and I owned about 25% of the business. So on paper, we were all of a sudden worth $25 million. I called my dad. It was like, "I won the lottery, Dad. Like, this is crazy." So yeah, it was pretty cool.
That's pretty awesome, man. Sorry, I'm going to ask this question because as you were talking, I was thinking about it. It's like, how'd you guys choose this business? Like, why did you start this business?
Yeah, so we kind of came to it through our passion for food and our passion for technology. So we love food. We John and I actually lived in we say our apartment, but we didn't live in the same apartment. We lived in the same apartment building, and I was living with a roommate. So John ended up being the headquarters of the business because he didn't have any roommates. So we were able to use his apartment as the starting off of the business. But that's where we used to throw dinner parties. We would go to the market. We would cook up cool stuff. We'd have taco parties, tequila parties, cool, interesting ingredients. We said, like, people people love these parties. Maybe we can do an iteration of this at home and help people cook ingredients that they're seeing on the shelves of the grocery store. And ultimately that was kind of the idea, and then layering technology and the demand for online grocery that was growing and necessary for Canadians, we thought at the time. So it was kind of a combination of our passions and right place, right time from an industry perspective.
So what's the difference between guys like you? This sounds like it started off very similar to these small kind of mom and pop shops that make meals. Like, when I was a competitive bodybuilder, like we would go to these places and they would make us, like 8 ounces of chicken and blah, 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 whatever. And it was
24 scrambled eggs.
Yeah. It was just a simple, here's chicken, here's, sweet potato, and here's some vegetable. And half the time I never ate the vegetable. Right? It's just like, it sounds, obviously you had a better meal than that, and you were much more passionate about the cuisine and the art of your product. And I don't want to be disparaging to the mom and pops, because sometimes some of these guys make some really good meals too. Like they do have some really good stuff, but what's this? I don't want to presuppose that it was psychology, but what was the difference between what you guys were doing and what they're doing, and how you propelled yourself to that next level? Like, I'm trying to just kind of thinking of the person that's listening to this going like, what do I need to ramp my business, 100 or 1,000x compared to what the guy's doing there?
Yeah, for sure. I think, your presupposition was correct in the way I think about it. Like the goals and psychology of the owners or operators of the business dictate what the business can be. So if you think your business is a $100,000 business, it will be a $100,000 business. If you think it's $1 million business, it will be $1 million. If you think it's $1 billion, hopefully it can be $1 billion business, and pat on the back, good for you. Like there's nothing wrong with that, but if you don't realize that, you're never going to be able to break through that ceiling. So I think, we've done a lot of Tony Robbins training, and I know you and I talk about it quite a bit, but being exposed to Tony Robbins community and the personal development community, I think the first thing that he would say is psychology of the business owner is what the chokehold of the business is. And so I think the fact that we found a business that has a lot of our passions directly involved in it, and we're able to share joy and food with Canadians all over the country, combined with the exposure that we had to entrepreneurs that were really limitless in their psychology of how big their businesses could be back at RBC, right? Like I worked on Bell buying Astral Media, which started off as a photo booth company like 60 years ago or whatever it is. And turned into like one of the largest Canadian media businesses. Like you don't just happen to fall on that. You have to have at least an ambition and desire and some goals on the wall that say, I want to grow to be X size, X impact, X, whatever the thing that kind of gets your juices flowing is. So for us, we brought on a third co-founder pretty early on in the business, Rafi, who's still with us today. And I remember a conversation with John, Rafi, and myself talking before Rafi joined, and Rafi was kind of asking like, hey, what do we think this can be? Like why are we not going to be the mom and pop catering business from down the street? And John said, we could be $100 million business in 3 years. And like, I don't think any of us knew what that meant or fully believed it with like the level of certainty required, but it was a line in the sand that was drawn pretty early that we're not going to be competing to be, answering the phones for the next 10 years. Cause that's not our ambition. And there's no knock on that. Like people could do that, but just know that it's a conscious choice that you're making. So I think that's really it. And it comes down to being exposed to lots of different parts of our life where entrepreneurs are, you could see it like a story about the size of their business or their team that either was empowering or disempowering. So why not pick a big empowering one?
Yeah, no, it's a great distinction. I think Was there a piece there where you guys had to fake it till you made it? Like, cause you
Oh,
kind of
for sure.
said, yeah, like you kind of said like, yeah, well, we kind of didn't really believe in, and so what did that
Well,
look like?
I think we definitely started to believe it, and we would repeat it, and um, it actually happened. So that was the other thing. Like we hit $100 million of sales in 3 years. So it was like, oh wow, like we actually ended up doing what we had put on the wall, or at least the valuation was 100 million. So we did fake it till we make it, but it wasn't. We weren't building to be a $5 million business or a $10 million business. We knew that there was going to be challenges and plateaus, and things would break on the path. But kind of big, ambitious goal got everybody really excited to go the extra mile and work the extra hour, and go the extra mile for the customer as well. So definitely some fake it till you make it. But I think people are inspired by big purpose or big numbers or big mission. Like it depends on the type of background and team that we're trying to build. And for the core founding group, that 100 million put a stake in the ground, and then the other stake that we continue to talk about is a million households that we're serving. And it doesn't necessarily have to be in Canada. Like today, we operate in Canada only, but in the future, we think there's an opportunity to continue to kind of grow and have a larger impact and deliver joy and nourishment to many people around the world.
That's a whole nother conversation. But I was thinking as you were talking, the question that popped into my head was like, and everybody, it's like the success story, right? It's like everybody goes, oh, like an overnight success, which is, complete bullshit. But can you talk to the sacrifice, and the tougher decisions that had to be made through the process from getting to, day one to 100 million in revenue, or even further into that? What's that been like?
Yeah, I think you have to be obsessive. Like if you want to run a business and have an impact on people's lives, like you kind of have to be obsessed about what you're doing, and get energy from it. It can't be a draining thing. So it shouldn't feel like suffering and sacrifice all the time. Although when you look back, you're like, oh, okay, this is probably a pattern that I could have recognized for sure. So for us, some of the stuff that comes to mind is, John met his wife like the first week we started the business, and my current wife, we've been together for a long time. So both of and Rafi as well, like all of us have significant others who have been part of building the business, whether that's 11 p.m. on a Sunday portioning kale because we got more orders than we thought, and they're all kind of like happy to do it, but like, cheap bastard, hire some people, like make some money on these, whatever it is, right?
We're having another tequila party.
Exactly. So I think asking lots of people that chip in was something that we did a lot in the early days, and sacrificing on sleep and social relationships, and delaying starting a family and stuff like that. I think if you can do it in many different ways, as we were saying before, but the way that we chose to do it was like obsessive at the beginning, and you're 7 days a week, always on. I used to go, in order to save like $5 a delivery, I would go wake up at 3 a.m., go to the warehouse, unload boxes to go to Ottawa 3 times a week. And like, it was like $200 like that we were saved. But like, I would go and I would sleep on the couch, and then employees would show up and we start the work. So it's just, basically whatever it took. We did a lot of all-nighters on the other side. We were not great at forecasting our demand at the time. So we would get more sales than we thought, which was a great problem to have. We wanted to please every customer, make everybody happy, over deliver on every expectation. So we would have all of our employees and team members that wanted to stick around. We just stay in the warehouse till whatever time we needed to be there to get our deliveries out. So lots of stuff around just completely committed to the organization. And in order to do that, you need to kind of put other stuff aside or we at least put other stuff aside at the time.
Yeah. Yeah. And I think the majority of entrepreneurs do that, you know, especially in the early days. And how's that transition for you guys? Like, are you still working 7 days a week? Is it like, you know, what's the ebb and flow been there, or the ups and downs, you know, through the process? And then I'm kind of interested in like talking a little bit about how'd you guys scale this thing up? Like we're going from where you were working 7 days a week and you're driving product and you're doing you know, I'm sure you don't drive product now. So it's like, where did that start to change and shift? And then where did it really, really start to ramp for you guys?
Yeah. So I think, you know, once we were able to afford a good team, bring people around, people that were, you know, ultimately better at doing the specific jobs than we were. So a better operations team, a better marketing team, a better product team, customer service, whatever it may be. You start to give a little bit of the responsibility and control away. I would say we're still very involved in the business. So we're in the office 6 days a week. We do, you know, we're part of a lot of the details of the meeting, especially during this kind of restructuring that we've gone through over the last year and a half. And I think that you know we found a good harmony in terms of, okay, you're in the details, you have a good team, and you're not necessarily always on, and you're able to balance different things in your life that you want to focus on, whether that be family, you know, health. Like I go to the gym 6 days a week as well. I have a pretty regular routine there. Like I'm not fighting fires as much anymore, which I think is the best. Is kind of my happy place to be. So that's kind of where it started, and that's just been a constant evolution over time. Like as we'd only be able to hire one person that you can kind of delegate stuff to, and then maybe you hire another one, and then you got to replace the one that you first hired, and you kind of go through this learning process over time. But yeah, today we have a fantastic team, and I definitely don't have to answer a lot of phone calls at 11 p.m. that a truck broke down or supplier didn't show up or whatever it is, right? Like just I still see them, but I don't have to respond, which it feels good that the team can take those type of things.
But in the beginning, like earlier you said you're the kind of guy that likes to like figure out the machine and how it works and all that kind of stuff. And that is, I mean, I'm curious, where was the shift for you, or was there a shift for you? Maybe I should ask that. A more appropriate question would be, was there a shift for you when you started to scale and you went from this entrepreneurial hands-on, like we are cranking the flywheel ourselves, to now I have to go start to build a team? I'm sure I know, I mean, you're one of the smartest guys I know. And I'm sure one of your, kind of strategies is hire the best people that we can go hire. Not sure at this stage if affordability is a problem for you guys or not, but you're trying to get the best talent, for what you can afford, I guess, and maybe stretching that a little bit. But was there a control piece of giving up control and really trying to, realize, like at that stage where it's like, I've got to choose. I mean, I can remember in my times where I've had to sit back and go, I've got to choose between, growth and control, and it's a choice. And I'm curious if you went through it and how that experience was, and if you had some tips for people to kind of identify you're in that kind of situation, and maybe some ideas of how to get yourself out of it and make that decision or make the transition.
Yeah, absolutely. I think that I don't think it's a you're ever done, right? Like it's a process that's always evolving, for yourself, for your team, for your business, for the environment. Like there's so much that goes into it. So I can't think of a specific moment that I was like, I figured out that I need to, delegate and leverage other people's expertise. But it happened progressively over time. The the first people we hired, everybody was paid 40 grand. Like we couldn't afford more than 40. Like, so you get the best person you can get you can pay 40 grand. So now we have people that earn multiples of that, obviously. And we still, we're still struggling with control and delegation all the time. But I think that's part of what makes founder-led businesses successful as well. And that's certain types of employees and team members thrive in that environment. So they come to that environment knowing that, like, I'm going to work for Dwayne or I'm going to work for Neil, and they're going to make decisions that I would have made when I was working at Sobeys, for instance, right? Like they would have, the level of care and connection is much higher in the founder-led business. And if you feel like you're an employee getting your kind of territory stepped on, you're probably not going to do too well in a founder-led business, because we think of our territory as the whole business, and it's not an ego thing. We want to help. Like, we want you to do the best job you could do for our customers. And we have a different perspective on the overall company than, a marketing expert or a tech expert or whatever it may be. So we try to give as much kind of feedback and transparency as possible across the business to enable that. But like I said, we still feel like we can't afford the best talent, despite having a big salary budget and having fantastic people. Google and Facebook some people make $20 million a year working at Google and Facebook. We're not hiring that person. So there's always another level. And I think, to your point on growth versus control, there's a couple good books around, the premise of what got you here won't get you there. So I think we've taken that very seriously. Of you need to let go of stuff to be able to focus on more strategic, more impactful, more chairman identity type role decisions that can have a huge impact to your customers and to your business. But I would just caution founders to never look away too fast. Like, that was one of the problems that we were describing earlier in our journey. Like, it's not because the person has 25 years as a finance executive or a operations executive or whatever it may be that you give it to them and they're going to do it better than you. Like, you designed this machine, and it's got intricacies that they don't necessarily understand. So stay close. We call it trust but verify a lot. So
yeah, that's a good phrase. Trust and verify. If you mentioned books, is there any off the top of your head? Not to put you on the spot, but is there a couple or one or two books that you would recommend in this area?
I think there's one actually called "What Got You Here Won't Get You There." So that's definitely one. Another amazing talent one is called "Who." I think it's Jeffrey Smart. So that's all about top grading, hiring, performance management, stuff like that. It's a great framework to use for bringing on people and setting expectations. I'm a huge consumer of content, and lots of other ones too. I love all the business biography books, Ted Turner, Steve Schwartzman, Bob Iger. Just read the Elon Musk brick that Walter Isaacson put out. So.
Oh, did you? Oh, yeah. I want to read that. Yeah. You were talking earlier about, this, if you're an employee and you're coming to work for a founder-led business, be careful. You have to be, enough backbone to not feel your toes are getting stepped on. That's not how you put it, but that was my paraphrase. What would you say or what tools have you used to be able to help balance that? You bring in a high quality person to help you grow your business. They want, some autonomy, and you're the owner and the founder of the business. And, you're kind of, as you've described, in the business and not taking your eyes off of it. What are some of the practices that you would say you've used that has helped bridge that gap to make them feel like they have autonomy, but you still yet have, some influence and or control in the process.
Yeah, yeah, for sure. I think one, setting the expectations is key, right? Like they can't um, an employee joining a business where the founders are very hands-on, like to use the Elon Musk example, right? Like like approving every piece of the spaceship or the car. Like he's extremely detailed, despite having $500 billion businesses. So you can't go work for Elon Musk thinking that you're going to do your own thing and you're not going to take his feedback. It's just like if you go in thinking that, you're probably setting yourself up for failure. And luckily,
it's a 72-hour job.
Exactly, and like, and if that, right, and the I think his reputation now is so well known that like people will opt in or opt out automatically. So it's not necessarily known that like it's not all founders that operate like that either. Some are more hands on, some are more hands off. But the risk of having the founder who started the business and designed the machine and figured out how all of this kind of fits together, being knowledgeable of all the pieces that move, and what's going to ultimately affect profitability or customers most. You just need to know. You need to know that. You need to have that conversation going in. You need to set expectations. Obviously, we've had a lot of success with people that come from other businesses that are very entrepreneurial or have founder-led cultures, because that's been, they're just like, hey, I love this. I like decisions get made super quick. There's no bureaucracy. There's no ego. Like you just go in, you make the call, you move on, and that's it. So that's been really successful in finding people that have that pattern in their background. And then at the same time, for us entrepreneurs, we also need to realize that people need that autonomy and they need to kind of learn on their own time and time scale as well. So set themselves up so that you're clear on expectations, you're clear on outcomes. If they do fail, it's a small risk that they're taking, and if they succeed, you're rewarding that outsized success. So nothing groundbreaking, but I think the expectations are pretty key.
It's interesting when you were saying that. I got a really good piece of advice from Keith Cunningham, who and was about creating it's called a My Style document. And I created I have a 3-page, it turned into a 3-page My Style document. Like here I am on leadership, here I am on control, here I am on, thinking and whatever it is, business strategy, tactics, all this kind of stuff. And it's just listed out, and there's literally 3 pages, and I review it for every time I hire somebody that's going to report directly to me. I review it with them line by line, and go, look, this is what you're signing on for. And then I put them in the room with my wife for a while and then they quit. Kidding. Speaking of wives, and not to get into your personal life, but I mean, you have an incredible balance with everything you've been doing. I mean, this has been an unbelievable journey. It's beyond inspiring, Neil, what you have accomplished and what you and Jonathan have accomplished as a partnership. I mean, you guys are not only partners, you're best friends. And correct that if I'm wrong,
for sure,
but I'm,
for sure. We live beside each
maybe
other.
not live on the podcast. No, actually he's not.
No, it's funny because we live beside each other pretty much like one street apart. Since meeting in 2010, we've probably eaten more than half of our meals together. So over 13 years, 50% of our meals. We own Goodfood together. We own another business together, a wellness retreat. We do all of our investments together. He's got 2 kids. I got 2 kids. It's just, yes. So we're quite intertwined, and we think it's we're better for it.
Yeah, no, I mean, it really is inspiring to watch. Like, partnerships are hard. And when I say partnerships, I'm referring to business partnerships. You are, I mean, you guys really set the example of how 2 partners in a business, can thrive on a consistent and ongoing basis. Is there any secrets to that? What would you?
Yeah, I think, I mean, secrets, I don't know if I would.
Or keys to
Yeah, I
success?
don't know if I would have all the secrets, but the stuff that has worked for us has been um, the have the conversation. Like, don't avoid the tough conversations, but know that it's not a personal not a personal thing. So we can. John and I share an office together, and the walls are pretty thin in our building. So we'll have at it. We'll go hard on a conversation, and people will like look in our office windows and be like, "What the hell's going on? Like, why are these guys fighting so much?" And then 2 minutes later, when another call, laughing, joking, like it's on to the next thing. It's not a personal thing. You're not attacking me. I'm not attacking you. We're having a tough conversation on the kind of on the facts and items that need to be discussed. So I think that's key. And in order to do that, you just need to drop your ego. Like you can't think you're right. You got to let it go. So that's been honestly, it's more. I'm just blessed that I found John, who has that personality, and he found me that I have that personality as well. And it was like it wasn't something we interviewed each other for. It just happened to be like, okay, like I think we can go high and low and high low and low high in terms of emotions and feedback, and we don't always need to be on the same page. And there's nothing off limits. So that's pretty key, and that works for us. Like I'm sure there's partnerships that are much more professional and kind of have boundaries and stuff. But like I said, we're fully kind of in this together. So that's definitely one. And I think we also have very similar kind of values when it comes down to it. Like we're both very growth oriented. We're both focused on what does the customer need. We both want to simplify things down to the ridiculous as much as possible. So if you start coming in with a 30-page plan or tons of bullet points or whatever, it's like, well, like what's the one thing I need to know or the two things I need to know, because that's what's going to actually make the difference here. So that's the other piece that we really.
No, sorry. I'm acknowledging. I'm acknowledging that piece is really important.
Yeah, I know you operate in that same style. So definitely that. And I think the other thing that we've come to learn more over the years of working together is we're all not good at the same thing, right? Like you have to have partnerships in executive teams and in any team, in business partners. So for me, like I'm much more the tinkerer. I'm the manager leader. I'm the guy that's kind of trying to figure out how to deliver the customer's experience consistently, and set the expectations with employees to do so. And I like to know, like I said, how the machine works. I used to watch the TV shows all the time on how it works when they would go into food factories, and it would just be how everything kind of pieced together. My dad ran an engineering consulting firm for a while as well. So that's just how I was brought up, and that's how I see the world. And John is abstract, pure entrepreneur, doesn't want to get too detailed on stuff because he knows that there's one or two things that are going to be the leverage points, and likes a lot of variety, and just has a completely different view on things, but realizes that he needs someone like me to help figure out how to execute and organize the plan. And I need someone like him to come up with the plan so that I can execute and organize. So we didn't know that going in. Like, again, we didn't interview each other and say, hey, do you have this? And I have this and whatever. It just kind of happened naturally. And now we know it, so we can play to it. So he asked me for advice on my strengths, and I asked him for advice on his strengths. And I know when he says certain things, how to, like, despite it being in the English language or French language when we're talking, I know how to translate it down to something that either the team can absorb or I can do something with, and he knows the same thing for me. And so we have those kind of complementary skill sets. And when we started the business, it was just, hey, you're going to do marketing, customer service, and product. I'm going to do operations. I'm going to do supply chain. And then, like I said, Rafi, our third co-founder, joined. When he joined, he took over the supply chain piece, a little bit of the photo studio and stuff like that. So it all kind of like just gravitated towards what we like to do. And then we realized, what we like to do is actually what we're good at, which is different what the other person's good at. And it's complementary. So we're actually greater than the sum of the parts.
And you park the ego, as you said earlier, you park the ego at the door, which is a huge piece, I think, especially in partnerships, well, and in intimate relationships as well. So like with your wife and you've got 2 kids. I mean, that has got to been a significant balance from, I mean, you started in 2015 where you're 8 years into this. And you've had 2 kids. And I know, I mean, I know you personally. I'm extremely proud to be able to know you. And I see how you manage your life with your family and the priorities and not even just, your kids, but your mother and your father and, your brother, but not that I know them, but it means a lot to you to, family and how I hate to use the word balance. I'm going to spit it out there, but it's like, but how you juggle the priorities of your life, and it's super impressive.
Thank you. Yeah, thank you. And obviously, I got a lot of inspiration from you as well. So don't sell yourself short either, Dwayne.
Yeah, no. Well, I mean, this is about you. It's not you. You're the guest. It's not about me. It's about you. And I just think, I want to jump into it. But then I also feel like maybe it's a whole nother podcast, because I don't want to start stuffing a whole bunch of things into this one. We've been on the phone, or we've been talking here now for an hour and 30 minutes, and it literally feels like about 25 minutes. So, I don't know. Would you be interested in coming back? Not that I want to put the pressure on you.
Yeah, of course.
I'd love to have you in the studio, get you out of Montreal and bring you into, well, not that I live in Toronto, but north of Toronto where I live.
Yeah, for sure. I definitely want to come see the spot.
Yeah, I'd love to have you here. And I'd love to talk, a little bit more about, how you balance the priorities of building a business. And I think that's a whole entire different podcast. And I hate to just try to stuff it into this one in kind of 10 minutes. I don't think it would give any value. So energetically, I feel like I'd love to have you back to specifically talk to you about that, because I think you get add a ton of value to, people who are in that, business is tough, man. It is like war. One of the toughest. It is war. I mean, and it's war every day, and as Keith Cunningham says, they're firing live rounds out there. The competition's firing live rounds, and there's a lot of pressure, but the people who are able to balance this or prioritize, the important things and still maintain health, wellness, psychology, family, love, intimate love, and all the things that come in business it's a powerful thing. And I mean, you've mastered it. So, I mean, I'm lobbing a ball out there for the next podcast.
Yeah, for sure. No, like I said, I'm happy to do it. And I would love to, and we can make it in person for sure.
Yeah, and for the audience, if you never see Neil again, he didn't enjoy it on the show. I've never plugged somebody hard enough to come back and have a conversation about a topic, but it's a topic I'm super passionate about. Mostly because I sucked at it early on. And I've had to force learn and grow, and you just kind of seemed to come by it naturally. So I'd love to spend another hour or so just chatting about it.
Yeah, good that it comes off that way. It's definitely a ton of work as well, as you know. So but
no, I know.
I think it's I got some topics and frameworks that I found helpful in it that I would love to talk about if helpful for people.
Yeah, buddy, I think it would be helpful for people. And I mean, thank you so much for being here. This has been an amazing, conversation. The story is your success, and congratulations on everything you're doing, and the turnaround from, the peak in COVID to what you guys are doing now. I mean, that in itself is probably another podcast too. I won't push my luck because I know you're busy, but that is like epic what you guys have done over there. To go and shift the mindset from this growth to free cash flow, and I mean, you're doing some really cool stuff over there with the business and from a leadership perspective. And congratulations to you, congratulations to Jonathan. Please say hello to him for me, and dude, keep doing your thing. I appreciate it. It's really, thank you for coming.
Thank you for having me, and I really enjoyed the conversation as well, and looking forward to the next one.
Awesome. Thanks, buddy. Take care, eh? Have a great holiday too.